There you go. Looks perfect now, Blake.
All right.
Yep.
Cool. Now, cheers for that. Yeah, as a way of introduction, my name is Blake Burton. I'm a non-executive director of DC2, and I'll get into the presentation. So a bit about DC2, we're an integrated provider of data center and cloud services. Pretty much everything we've done to date has been out of our tier 2 data center in Osborne Park. But actually a couple of weeks ago, we brought online our tier 3 facility. It's a much larger data center, which is in BIBRA Lake. It's a southern suburb of Perth. We have DC Modular, that's our high density modular data center division. And essentially what we do is build containerized data centers and put them directly on power generation sites. So think solar farms, wind farms, that type of thing. And we also have DC Soft, which is our software arm of the business. And what I'll talk about there in particular is what we call the Microsoft opportunity. It's a Microsoft SPLA reporting tool that we're developing, but I'll get into that a bit more later on. So in terms of our capital structure, we listed last year of November 2020 at 20 cents a share, currently sitting between 30 to 32 cents a share for a nice bit of capital growth. Our market cap's just under $20 million. Relatively tight share register. Our top 20 make up 56% of the shares on issue. But what we get really excited about is management and the board. We hold about a third of the company. So we've got skin in the game and want to see this business succeed just as much as every other shareholder. In terms of management and the board, we have Justin Thomas. He's one of the co-founders of DC2 and is our managing director. Previously built and sold a software business to Uppy Data. Also has previously built a data center down in Henderson, another southern suburb of Perth, which he sold to Amcom. They were then acquired by Pocus Group, who in turn are getting acquired themselves. Cam McLean, a non-executive chair, he's got decades of experience with a number of service-based businesses, including HP. Myself personally, a number of years ago, I started a web hosting business, built it up to just under 4,000 customers, which I sold to Australia's largest private host a couple of years ago. Mike T, our general manager, he's started a number of IT businesses, which he's gone on to sell. And Mark Dicknam, also one of the co-founders of DC2, he started one of Australia's first ISPs, which he sold to IronNet. So with DC2, pretty much everything to date or up until the point of listing was self-funded with very little external capital. And that got us to just under $2 million a year of revenue last financial year, but also a real loyal and growing customer base. We have what we call channel partners. These are essentially IT providers, MSP companies that will wholesale our services to. They'll then on-sell to their customers, but we do also sell directly to end user businesses. We raised $5.5 million last November. And from that, we have a number of value generating initiatives where we'll talk about a bit more in this presentation. So in terms of our sales channel, I'll just give you a bit of an idea of how that works. So typically we've been very channel partner focused. Now, channel partners are your IT providers, your managed service providers. We have a suite of data center and cloud services that we sell to them at wholesale rates. They then on-sell to their customers at retail rates. We do sell directly to end user businesses. And because we only had the tier 2 data center before, traditionally that's been smaller to medium-sized businesses, but we now can go after much bigger customers with our tier 3 data center, enterprise, government contracts. At the time of listing, we took on a sales manager. So that's about 6-7 months ago now. He had very much enterprise experience, worked for Fujitsu Data Center, F5 Networks, Fortinet. About a month ago, or probably a bit longer now, maybe 5 weeks ago, we just employed 2 new sales resources in preparation for our new tier 3 data center coming online. And also since listing, we've signed a number of new channel partners as well, a number of new channel partner agreements, so they can begin to sell our services. So this gives you an idea of where DC2 was up until the point of listing. So consistent year-on-year recurring revenue growth. Now, again, this was all based on very little external capital, pretty much all self-funded, and also traditionally from only small to medium-sized businesses who are much smaller contracts. In the last couple of years, we have had some one-off revenue, definitely not averse to one-off revenue. It's mostly service sales, hardware sales, we'll take any money that comes our way, but our focus is really on growing that recurring revenue. So in terms of the market, the data center and cloud services market, it's been growing at double-digit revenue growth rates for a number of years, and that's expected to continue. There's been a big shift in business mindset where traditionally your offices, they'd have their servers, their hardware, all stored on site in the communications room. That's now shifting to a cloud-first policy, moving all your data into a data center onto the cloud. COVID's been great for the industry. I do feel bad for saying it, but it's true. A year ago, Overnight, things changed. We all went into lockdown. People had to start working remotely. This is what data centers and the cloud are built for. So thousands of people, if not millions of people, can all connect in at once and access their data. We're using Zoom right now. That's a cloud service. Things like Microsoft Office 365. These are cloud services that are made so no matter where you are in the world, you can access your data, and they're all hosted in data centers. What's also been great about COVID is people starting to wise up to the issue of data sovereignty. Traditionally, customers would come to us and say, oh yeah, my data's in the cloud. Yep, I don't care where it is, it's in the cloud, that's fine. They're now saying, well, where is the cloud? Is my data stored here in Australia? Is my data stored in the US? Is my data stored in Singapore? Where is my data stored? They're wising up to the fact that they don't need the added political risk of having their data stored in another political jurisdiction. For certain industries, finance, health, it's mandated that your data needs to be stored here in Australia. That's not the case for every other business, but they are wising up to the fact that data sovereignty is important and you don't need that risk of having your data stored overseas, which is great for us because with DC2, all your data is stored here in Australia. So I'll get a bit more technical on this one to explain the difference between a tier 2 and a tier 3 facility. So pretty much everything we've done today has been out of our tier 2 data center in Osborne Park. Small little data center, 34 racks, a couple hundred kilowatts of power. It was great for that small to medium sized business. It really served its purpose, but what we get really excited about is our new tier 3 facility in BIBRA Lake. So we announced 2 weeks ago, this is actually online now. We've got 20 racks online. And the difference is that a tier 3 facility, essentially the way we design it and build it, we can get an independent institute, the Uptime Institute, they come in and certify that we can keep customers' data online 99.982% of the time. And it is really critical because it's a minimum standard that a data center needs to be for government, enterprise, and now even some medium-sized businesses. So traditionally, we couldn't go after these bigger customers. At the time of listing, we announced it'd be about a 240 rack facility. It's now looking like it's going to be between 240 to 400 racks. Also, the previous owners, they'd spent between $8 to $12 million fitting out the facility. We've picked it up for pretty much the cost of the lease, which is great for us because it's saved a huge amount of CapEx for us. It's really going to unlock that future growth for us. So as a data center provider, similar to like your next DCs, I'm sure everyone's heard of them, we can offer co-location services. So with co-location, we essentially provide you with just some rack space. Now you bring your own server, your own hardware. We don't care what it is, as long as it's not illegal. You bring in your own equipment and we'll charge you about $1,600 a month as an industry standard for that rack. And you do whatever you need to do within that rack space. Now we can do that as a data center provider, but we're also a cloud services provider. So on top of that, we can add networking, we can add cloud storage, we can add cloud compute, we can add management. We can add all of these additional services where the end result is we start making more money per rack. It starts going towards that $50,000 a month plus per rack. And the bigger enterprise, the government kind of customers, that's the sort of money that they typically spend. So what's quite encouraging is at the point of listing, not only do we have a lot of existing customers, but also prospective customers coming to us saying, when are you going to get this data center online? We want to move our data into your data center. So we decided we need to get this thing online as quick as possible. So 2 weeks ago, we announced that 20 racks, they're now online. About a month ago, just over, we employed 2 new additional sales resources and said, let's start selling as quick as we can. So we expect it to be revenue generating very shortly. In the background, what we'll do is continue with the construction of the data center so we can get our tier 3 accreditation by Q3 of this year. And that's important because that's when we can really start going after the government, the enterprise, the bigger contracts. It really will transform our business. We'll be the only provider here in WA with our own tier 3 data center and ISO 27001 cloud platform. So at the moment here in WA, either you have your own data center and you sell someone else's cloud services, or you have your own cloud platform, or you sell someone else's data center services, sorry. It's a bit more common over East. Companies like Macquarie Telecom, they're already doing this in Canberra, they're doing it in Sydney. They're not yet here in WA. So we'll be the only provider with this integrated setup. It's a real value inflection point. I keep talking about the small business, the government, the enterprise contracts. Typically, we've gone after small to medium-sized businesses. These are businesses that spend $1, $2, $3, $4 grand a month on cloud services. But when you start getting to government and enterprise, they spend 5, 20, 30, 40 grand a month on cloud services. It's not uncommon for them to have $500,000 a year in cloud spend, and they like to be locked into long-term contracts. It gives them that surety of price, and it's great for us because it gives us that surety of revenue. The end result is now this data center is online, and once we get that tier 3 accreditation, we should start to see some significant revenue growth. Next, I'll talk about DC Modular, which is our modular data center division. So essentially what we do is build real high density modular data centers and place them directly on power generation sites. So as you can see here, solar farms, wind farms, biogas facilities. Now we do this so we can access globally competitive power prices, what we call behind the meter. So we place them directly on that site, access that cheap power. And as an example, we can sell power to our customers cheaper than what we buy it for here currently at our BIBRA data center. No one else in Australia has this model. And it's really important because when you have real high density computing, think of things like crypto mining. I'm not sure if people here are familiar with the crypto space, but crypto mining is really popular, but it chews to a heap of power. When you set up a crypto miner, it chews to a heap of power. And traditionally in Australia, it's not been profitable to mine cryptocurrency. With our model, it is profitable to do that. Even for things like hyperscale computing, this real dense computing that chews to a heap of power, it changed that model. So here in Australia, you can actually afford to do this. It's becoming a bit of an ESG play for us. So as of, I think it's 2 months ago now, we're up in the Midwest. That's on a wind farm. We sent one module up there, and from the demand we're seeing, we're building another 3 modular data centers to send up to the Midwest. We've got an MOU in preparation with a solar site in Collie. We expect that to be online this year. Victoria, currently under non-binding MOU. We expect that to go to binding MOU and then be online this year. That's a biogas facility. So it really is becoming that renewable energy play. What's been encouraging for us is not only are we seeing strong demand from customers, especially people with that crypto mining equipment coming to us, we're also seeing strong demand from energy providers. They're saying, we want you to put your modular data centers on our sites because we become a customer for them as we buy that power. Next, I'll talk about DC Soft and what we call the Microsoft opportunity. So Microsoft Windows licensing is a bit different for data center cloud services providers compared to what you're probably typically used to. So with us, whenever we use a Windows license, whether it's Windows Server, Microsoft Office, RDP, no matter what it is, we have to get an admin person or a tech person to go through and manually calculate each month, at the end of each month, what licenses we're using. They manually add up all those licenses and then submit that to their Microsoft distributor, the biggest here in Australia, BIBRA. So it's a really costly exercise in terms of the time it takes to prepare these reports that we need to submit every month. But then also what happens is every now and then Microsoft will come along and audit you. And they'll say, you're using this many licenses, you've submitted this, but you've actually reported this many licenses, there's a difference. Now, when there is a difference, you cop a fine. For bigger businesses, the fine can be into the hundreds of thousands of dollars. So it's a really costly exercise. DC2 ourselves, we've been audited before and we're one of the few to come out unscathed. So we like to think we know what we're doing in this space. And what we've done is developed a Microsoft SPLA reporting tool. So at the end of each month, you can click a few buttons and it will automatically give you that Windows license count. So it cuts down on all that admin time. It cuts down on having to employ someone to prepare these reports, gives you that number. And then from there, you can submit that report to your Microsoft distributor and be comfortable that if you're going to get audited, you're not going to cop a massive fine. So here are our near-term milestones, what I like to really call our news flow. So a couple of weeks ago, BIBRA that came online. We expect that to be revenue generating shortly. We continue with that tier 3 construction in the background. So by Q3 of this year, we can get our tier 3 accreditation, and that's where we can start going after the bigger contracts, the government, the enterprise. We have our cloud platform here in Perth. We'll be launching that over East as well. So then we become a national cloud provider, coast to coast, national point of presence. DC Modular, we expect that to keep going from strength to strength. We're already up in the Midwest on the wind farm. We'll send more modules up there. We'll get Collie online this year and we'll get the Victoria site online. And then we'll begin to look at additional sites. So lastly, I'll leave you with a bit of a peer comparison. I mean, these are all companies in a similar space to us, but they listed much longer ago. So NextDC, I think that's probably over a decade ago now. $5 billion company, data center provider, really good at what they do in the data center space, but all they do is just data centers. We're a bit more similar to Macquarie Telecom. So billion-dollar company, they offer data center services, but also cloud services, also communications. Much stronger over East, got a real big presence over there, not so much here in WA. Over the wire and 5G, relatively new listings in comparison. I think it's been about 4 or 5 years. Very similar service offering, data centers, cloud, communications, but their model's a bit different. They're very acquisitive for growth, where for us, with the money we've raised and the value generating initiatives that I've spoken about, our focus really is on growing revenue organically. We should be able to start significantly increasing our revenue, which should then in turn lead to a nice increase in our market cap. So my name's Burton. I'm a non-executive director of DC2, and I'd love to open the floor up to any questions now.
Yeah, we've got one in so far, Blake, so let's tackle that one. The unit economics on 1 megawatt in terms of upfront capital costs, revenue, EBITDA, if you could, maybe just like break that down for us.
Yeah, so there's two different ways there. So we've got the modular data center division, which is a bit different to the that tier 3 data center. So usually as a rule of thumb, I think each megawatt of capacity in CapEx is usually around that kind of $10 million mark. So that's where we're quite fortunate, where there's been already a significant spend on the data center down in BIBRA Lake. In terms of revenue, now this is where it does vary a bit. So your traditional data center providers like your NextDC, you could look at, say, their revenue, I remember it's about 250 million. Their megawatt utilized is about 70 million. I think their number works out to be around $3.5–4 million a year per megawatt of capacity utilized. Now, when you start going into not just data center space, but also the cloud services space, you start to see more revenue per megawatt. The closest one would be Macquarie Telecom. The only thing is it's hard to find what their megawatts are actually utilized. You can only look at their capacity. So their revenue, I think it's around that 250 to 300 mark, but they've got 50 megawatts of capacity not actually utilized. That works out to be about $5.5 million a year in revenue. But I reckon if you look at their actual utilization, the revenue would start to go more towards that $10 million a year per megawatt of capacity. And that kind of suits our mold as well. With DC2, we had 200 kilowatts of capacity at BIBRA Lake for that $2 million a year revenue, just under last financial year. The DC modular side of the business is a bit different. So that's really about low capex, low opex. It's just making things like crypto mining profitable. Each megawatt of capacity for us in capex is actually only about 250, maybe 300 grand. But it's not tier certified. It really is just building these containerized data centers as cheap as we can, so we can offer that cheap price for customers so they can get that low OPEX. Each megawatt of revenue, I know the 160 kilowatt container we've got up there, I think the capacity on that's 14 grand a month revenues. So I should be able to extrapolate that. Yeah, I think you start then looking to around 90 or 100 grand. So that's a month, 100 grand a month revenue. I think it works out to be about $1 million a year revenue per megawatt for the DC modular side of the business. And I can give you some numbers on that as well if you start wanting to look at profit and EBITDA. We buy power for about 8.5 to 9 cents per kilowatt hour directly from the power generation sites. As we start to consume more power, we're going to try and negotiate that down. We just purely mark that up. So we'll sell that for between 11 to 14 cents a kilowatt hour to the customer, depending on how much power they want. So hopefully that answers that.
Yeah, there's a lot of numbers there for somebody to digest. I'll definitely be watching back.
Yeah, if you're into your numbers, I always try to strip it back, but if you're into numbers, we got plenty.
Yeah, they'll definitely be watching back your answer on the YouTube thing. Just one from me. I mean, you say Macquarie Telecom is a close competitor, but they don't really, or they don't presently have an operation in WA. When you go for the enterprise guys and the government and stuff like that, I mean, two issues for me. Does latency come into the decision factor for them? And then, the government and maybe the larger national enterprises, working on a national footprint, splitting the risk in having, their WA data in WA and their, East data in, somewhere like Sydney or Brisbane or whatever, and the they're not keeping it all in one location. They're splitting it out. Do those considerations come into it when your kind of tier 3 sales force hits the ground?
Yeah, exactly. Latency is not an issue for everyone. It really depends on what application you're running, but for a lot of people it is as well. So we offer like a virtual desktop solution where customers are essentially, it's like a computer, but they're connecting into the cloud. Latency does become an issue, so you want to have that close proximity. So for us here in WA, we can access, a lot of the miners or even schools where we'd be chatting with. They do want that close proximity. And that's a big reason why we want to launch the cloud platform over East as well. So if we do then start to go to customers that have that national presence, we can offer them that solution here in WA for their WA staff, and then over in Victoria or Sydney, what have you, for any staff or any officers that are over there.
And the splitting the risk in keeping, WA data in WA and keeping, East data somewhere in Sydney or Melbourne for the national guys, would that be an attractive selling point?
Yeah, and again, it definitely depends on the customer. Like, you never have all your eggs in one basket. Usually what it is, there's different ways to set up this sort of platform. You might have all your data here, say in WA, for your WA guys, and data in Sydney for your Sydney guys. You might have your national data, everything in, say, Sydney, and you back up to here in WA as well. You always want to have that sort of redundancy there. It's not like you just put all your data on one site and you're good to go. You at least need that DR, that additional site, just in case things go bad, something goes wrong. Yeah, you definitely want to split that out.
Okay, great. And let me just see here now. How does DC2 compare to DXN? I'm not sure if you're familiar with those guys. Just on a high level, looks to be very similar businesses according to the question.
Yeah, I think probably not the data center and cloud side of the business. They don't do any cloud services. People do compare our DC Modular division to them, but it is a different model. So essentially what they do is build really ruggedized, like tier 3 data centers for the miners or whoever it is. I think a lot of the contracts are coming through are miners, and they'll manage the data center for them. For us, our model really is about attracting that low OPEX, that low cost for the customer. So we own the data centers, we'll build the data centers, we'll put them directly on the power generation sites. We'll have that agreement with the power generator, so we can offer that real cheap power price. So things like your crypto mining, your hyperscale computing becomes cost effective here in Australia, where traditionally it wasn't. They don't have that sort of model. I think they build the data center and they might ongoing manage the data center for the customer. But it's my understanding, at least, is it's the customer's data center.
Okay. And then, I mean, you kind of got four streams to the business. Do you want to, in time, where do you see, the kind of largest proportion of kind of revenue and profits coming from? Is it the tier 3 data center, or do you think it's going to come more from the product you're showing to Ripe, or where do you think is the biggest opportunity out of the 4 offerings you've got currently?
Yep. It's interesting. When we first listed, I hands down would have said the data center and cloud division, just because once your data center is up and running, it's real high fixed costs, but it becomes really profitable once you start to add customers on board. There's very little marginal cost, just a bit of power. And I still maintain that's going to be a massive part of the business, but DC Modular is really exciting just from the conversations we're having. We're already up in the Midwest, and as we start to generate some decent power, even the modules we're looking at doing over East, they're not going to be 160 kilowatts. We'd start looking at, say, 400 kilowatts, and we might be building a couple of them. That is a heap of demand for people wanting to access that cheap power. I know crypto is just going like ridiculous at the moment, and that's where a lot of this strong demand is coming from. We're also seeing strong demand for the hyperscale and real high density compute. So I actually believe DC Modular could be a decent part of the business as well. And we're putting plans in place to make sure that happens. We don't want to be bottlenecked at any point in that business because there is so much opportunity there. DC Soft, I personally believe that would be a much smaller part of the business. It has been hard for us the last few months trying to get developers. We're doing a lot of bug testing before we can kind of beta test and showcase the product. It is really hard, especially here in Perth, getting good developers. So I'd say it's probably going to be a much smaller part of the business.
Okay, great. I'll just see now we got Any more questions? I don't think we have. Blake, we might leave it there unless we get one more question. We're pretty much up on time anyway. We're finishing 2 or 3 minutes early, but maybe one question from me. Is there, I know you've referenced Macquarie Telecom and a few others in the peers on the DC modular space, just because it's such an attractive kind of opportunity. Do you know of anybody internationally that is listed that's doing kind of something similar, or are you guys kind of
No, and that's
breaking new ground in terms of this particular offering?
Yeah, I'm not familiar with anyone, and that's a big thing for us, is just having that first mover advantage. And that's why I was just saying before as well, we're making sure we set this up so we don't miss out on the opportunity, because I strongly believe as we start getting more customers on board and people see what we're doing, there's going to be other people wanting to come into the market and do a similar sort of thing. So it's, yeah, very much watch this space. Definitely no one's doing it here in Australia. I'm not familiar with any listed companies doing this sort of thing. So it's going to be an interesting one.
Okay, great. Okay, Blake, we'll leave it there. Thank you very much for joining us early morning your side in Perth.
Sorry.
And
cheers, Mark.
If anybody wants to watch back that answer on the unit economics, it'll be up on the Coffee Microcaps YouTube channel probably around 9 a.m. Sydney time tomorrow. So we will leave it there, and I will speak to you all next week.